Master your money, free your future. Welcome to Budget for Life. My name's Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. In this video, I want to show you exactly when GameStop sold its soul. Because in a past video, I've talked about how basically 2017 and 2018, very clearly management had an agenda to destroy and deteriorate the company from within. But in this video, I want to show you how that plot was actually well underway many years before that. I'm going to show it to you with the numbers and with GameStop's financial statements. If you learn anything, leave a like. Also, before I get into it, thank you to those who have already subscribed. I'm on a march to 2525. I'm calling it the Halo Sub Club. I want to get there by earnings. So if you want to be a part of it, we'd love for you to be a part of it. Once we cross 2525, there will never be another opportunity to be a part of the Halo Sub Club. Also, I want to say thank you to the friends of the channel and the fans of the channel. I appreciate you guys, and I try to offer as many perks as I can to say thank you because all the earnings of the channel go to DRS Booked Genie shares. Let's catch up with GameStop historically. Okay, what do you guys think of this business? Right, that in 2003, right, the fiscal year ended January 2004. That's fancy for 2003. February to January, right? Doing 1.5 billion in sales, then 1.8, then 3 billion, and then 7 billion in 2007, and then 9 billion, 9 billion again in 2009. This company, the legacy historical GameStop retailer, was crushing in so many ways. And not just from expanding their stores, but even expanding the efficiency of their stores. Check out the sales per store that the legacy GameStop retail business was generating. In 2003 and 2004, they were doing about $500,000 a year per GameStop store. That jumps up 20% year over year to almost 700,000 per store in 2005. That jumps almost 50% year over year to 1.1 million in revenue per store in 2006. That jumps again, right? Almost, probably 17, 18%, right? From 2006 to 2007. So not only are their revenue numbers growing astronomically, right? From 2004 up to 2007, but their efficiency is growing as well. Then in 2008, they grow a little bit as well, but more modestly. And then in 2009 and 2010, despite their total revenue numbers growing, right, from 8.8 to 9.1 to then 9.5, all of that growth in total sales revenue was new store growth, not sales per store growth. Now, opening new stores at a 1.4 million in annual sales per store, the financials of that might make sense, but I want to show you why this was the moment, in my opinion, that GameStop sold itself out, not just from the financials that we see in these years of GameStop, but also what GameStop did after that. And hopefully you learn a little something from it. So in 2005, look at what GameStop's strategy was, right? How did they go from a company that was doing 500,000 in sales, right, to 1.3 million, right? How did they almost triple their sales per store over this period of time? Well, here was their growth strategy. Okay, back then, they were going to aggressively open stores, they were going to increase comparable store sales, and they were going to capitalize on growth and demand. And they show you like, hey, our game software and used products are growing by 20% and 27% respectively year over year. Then we're also going to continue to grow our used business, and we're also going to invest in our brand, right? We're going to make sure more people know about GameStop. So GameStop at this time, right, this was released, at the end of fiscal 2025. Did it make sense for GameStop to execute on this strategy, right? We need more stores. We're going to make more money per store. And the reason we can do both of those is because the demand in video games is growing, and our ability to increase awareness and to increase the portion of our products that are coming from used, we believe in both of these. We don't think we are a saturated brand yet, and we don't think that the used video game market is fixed as far as our ability to scale that side of our business. And you can track the management's execution by the numbers, right? Just 3 years later, they're doing more than double in sales per store, right? And proportionally, the used business didn't necessarily grow relative to the new hardware software business. So that's something that you can look back on and say, okay, this portion of management's strategy, I'm not sure how much I buy it. I'm not sure if they're able to execute that, right? But increasing brand awareness, it seems like, was definitely a part of their ability to scale from 0.48 to 1.42 in just a few years' time. Obviously, though, this was the last bullet point for a reason. GameStop didn't just decide one day, let's start marketing, and then their sales tripled. What happened is there was a demand in growth, right? There was a there was a demand for video games, and video games were growing quickly. And so, of course, even as they're growing more stores, the demand for games was growing faster than even their store count expansion was. As a result, they're increasing in their sales per store. Makes sense. You can track what management said they're going to do, and then you can look at what they actually did to verify that, yeah, what they are saying is legit. And how did the market respond to this increase, not just in scale, right? Not just in revenue, but increase in efficiency over this period of time, right? From 1.5 in 2003 to 8.8 billion in revenue in 2003 to 2008. Well, check it out. 2003, those numbers get reported around February, right? They go from a $1 billion company, and before that, they were even less than that, right? But they finally crossed the billion mark after these financials come out in 2003. And look where they go over that period of time. In just a couple more years after fiscal 2004, okay, now they're at 1.1 when they release these very modest goals, right? This legacy tiny GameStop, everyone thought was worth about $1 billion. After 2005 is when we see this growth strategy and we start to see a little bit of demand pick up and clarity on how they're going to scale it. When is fiscal 2005 reported? In January, February of 2006. So people are eating it up, right? They triple in market cap from 1 billion to 3 billion based on a clear growth path and growing demand. And then look what happens just another year later. Right now they're a $4 billion company after the 2006 numbers come out. After the 2007 numbers come out, they are over an $8 billion company, even eclipsing $10 billion. What happens though in 2008? Well, first of all, you see a market crash globally, right? But more importantly, the sales growth is slowing. The sales growth is slowing in 2008, and simultaneously, you're hit with a macroeconomic crash. If you were management of this company, what would you do after seeing sales skyrocket, right? Growing quickly, and then slowing down. And then after you see years of macroeconomic support and then hit with a macro crash, what would you do in 2008, in 2009, in 2010 in light of a stagnant sales per store and a difficult macro backdrop, likely what you would do is either close some stores or keep the stores you have and begin to pay down debt, right? Just try to cash flow as much as you can. But what did GameStop do? They continued to add more stores, right? From between 2007 and 2008, they go from 5,200 stores to 6,200 stores. They opened 1,000 stores in 1 year during '07 and '08. What happens then? The next year, they add another 250 stores in 2009. In 2010, they add another 220 stores. So, in the middle of a macro crisis economically and in the middle of their stock equity plummeting, down to 3 billion from 10 billion, they are still continuing to grow their store count, right? They're still spending money despite the fact that there is no sales growth per store. So why did they do this and what is their plan moving forward? Well, let's see, right? In this 2010, let's see what management is saying about the company because we saw what they said in 2005 and we saw how that paid big dividends in a short order, right? Doubled their sales per store in just 2 years with a very clear strategy. Let's see what's changed, right? Because sales is obviously slowing, sales per store, right? There's no growth to be had. And simultaneously, we're in a macro crisis. So, what's GameStop's plan? Look at the filing that they offer us in January of 2010. Business growth and strategy. Our goal is to continue to be the largest, right, video game store. We plan to strengthen that position by continuing to execute our proven strategies. Okay, red flag mamma jamma. You see a company that for 3 years has not grown, and what they're saying is they're going to continue doing the same things. That does not make sense. Look at this. Oh, sorry. Let's get rid of the old one. Increase comparable same store sales. Okay, so just like they said in 2005, they say they're going to increase comparable same store sales. But how are they going to do it? They say they're going to increase market share. So they don't even think the market is growing, right? They're saying we're going to try to get a larger percentage of the market of the video game industry. How are you going to do it? By increasing awareness in the brand and by increasing membership in loyalty programs. And again, by expanding our sales of used video games and capitalizing on the growth in demand. So then they break that down, right, in these subpoints. Look how long-winded they are talking about how they're going to increase GameStop's brand awareness. And there's something really important I want you to see in here, okay? Because in 2007, they launched a huge campaign to increase awareness of the brand, right? We heard them say in 2005, one of the big ways we're going to drive same store sales is by investing in brand awareness. And they did, right? They spent a ton of money to make sure people were aware of the brand. And now here they are, 5 years later, saying they're going to make people more aware of the brand. Like, how many more people do you think are out there that haven't heard of GameStop yet? It's 2010, you know? Doesn't make any sense. And then look what they tell you, okay? Where is it in here? So they talk all about this power ups, right? We have members, we have people subscribe to an email list. Look at all these words. Email lists means we're going to make more, you know? We intend to increase customer awareness of the GameStop brand in connection with these efforts. In the last 3 fiscal years, we have increased our amount of media advertising. In other words, in 2010 and in 2009 and in 2008, GameStop was spending more money every year on advertising. So even though the sales per store looks flat, the the net um, like production of the stores is actually declining, right? The increased media spend, the increased ad dollars were masking an underlying declining business. And if this was your business, would you try to put a band-aid over like a declining demand by just spending more and more on ad dollars? Or if your business was making less and less money, would you maybe want to cut costs, right? If you were incentivized for this business to prosper, wouldn't you want to cut costs? They spent more money each of the last 3 years in marketing and still did not generate a single cent more. I mean, this is, like a single $10,000 more per store over that same period of time. Ridiculous. The number one way they're going to increase same store sales is by doing what they've already done. There's nothing new here. And so to put this towards investors is basically you waving the white flag with a lot of fancy language saying we're not going to do anything. We're going to continue to do our proven strategies. Well, your proven strategies are proving to generate no growth at all, right? So why would you say you're going to keep doing the same stuff? But it gets worse, guys. What are they going to do next? They're going to increase sales of used video game products. Again, we saw this. You said this in 2005, okay? And the used portion of your business, it went from, what was it before? 26, or that's in 2010. Okay, okay, okay. 2005, it was at 26.1%. 2009, it's at 26.4%. So, and then 26.1% in 2010. So you told us that back then that you're going to increase the portion of used. It hasn't moved one iota in 6 years. Okay, so I don't care how long you explain this to me, you do not have an ability to increase the portion of your sales that come from your used business. We've known this for 5 years now. You tried and you failed. It's the same 26%. Okay? And then look at the next thing they say on how they're going to increase comparable store sales. They're going to capitalize on growth in demand. But do you remember what they said in 2005? They said, hey, like these different businesses are growing 20% and 27%. And so if we can ride that wave, right, we can continue to expand stores and grow sales per store, the double whammy bazooka, right, of retail growth. But look what they say in their explanation on how in 2010 they're going to capitalize on the growth in demand. While sales of new video game hardware decreased, wait, hold on. You're going to capitalize on growth and demand, and you're telling me demand is waning. Demand is shrinking, right? But our customer base has expanded. Okay, that's not the same thing as growth in demand, okay? Our sales in new video game and used video game products have grown. Oh, okay. What kind of growth are we talking about? Approximately 6 and 3%. 6 and 3% growth. Does that sound like growth rates that you should capitalize on? Does that sound like growth rates you should spend money on? If you were this business, would you be adding stores, hundreds of stores every year while saying things that don't make sense to your investors? No. It's obvious that GameStop sold itself out, but I'll make the case even stronger because it gets crazier. So crazy. Ah. And then they explain that we are going to continue adding stores, right? We, even in 2011, right? We're going to close some stores, but we're going to add even more stores than we've closed, right? We are still going to open stores. We're going to spend more money, even though nothing we're saying is making sense and nothing we're saying is working. Absolutely crazy. And then they just keep like the more long-winded you are about your business strategy, it's like the more of a red flag, right? Oh, we're gonna buy, or grow our online video game platform. We're gonna get a broader audience, right? We're gonna enhance our image. Okay, we're gonna consistently achieve the same thing we've already been doing. That does not improve anything. We're gonna spend money on, you know, info systems and distribution. There's nothing here that justifies a growth story, right? And investors saw it, right? There's nothing about this that moved the needle. In fact, when they released these numbers, they were still at about a $3.5 billion valuation. And as a result of this ridiculousness from management, they go down to 2.5 billion, 2 billion, right? From 10 billion just a few years ago. To me, this is the moment somewhere between 2009, 2010. You could argue 2008, right? But they did still grow sales per store a little bit. And I don't know when exactly the macro of '07, '08, '09 began to hit the fan, but certainly once that hit, you should have seen a screeching halt on continued ad spend, continued growth, if this was a conservatively run or a modestly run business, unless they were still seeing crazy growth in sales per store, but they weren't. They're just adding, 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 but they're not actually growing anymore. It's no longer multiplication, it's just addition, but there's actually more subtraction than there is addition, aka there's more expenses, more ad spend, right? More glut. We're gonna buy a company jet. Like there's more. We're just here to milk Wall Street money and live our corporate executive life while we can than there is new revenue. And so profits were actually coming down, right? They're adding stores, but they're adding costs faster than they're adding stores, and their stores aren't growing, their stores are just adding. So what does GameStop do in the next year, right? So after 2010, one more year goes by, they start spending money like bonanzas, and they say, "Hey, we're going to start selling mobile products. We've got a new growth story for you. It's mobile. We've been doing video games, we've been doing consoles, but we've been doing accessories, but we've been missing out on tablets, smartphones, and MP3 players, right? This is going to be the new product line that generates more sales per store for the GameStop store count. This is going to be what moves the needle for us. We're going to take market share from Best Buy. This is going to be how we grow our market share. And look what they did in their first year for their mobile business, mobile and consumer electronics, $12 million. dollars. Okay, nothing to speak of as far as mobile and electronic growth. And what do they start to do? Do they do anything to fix their legacy business, right? To increase sales per store, right? To become more efficient in their core operation. That's what any of us would have done, right? But instead, they just distract with smoke and mirrors through acquisitions, right? Hey, guess what? We just bought Buy Mytronics. Hey, we're going to open Spring Mobile stores. We're going to open Cricket Wireless stores. Down the road, they're going to open um, Simply Mac stores. Down the road, they're going to purchase ThinkGeek, and now we're scaling collectibles, right? They kept changing the growth narrative, but the reality is all of those growth narratives were likely just to appease investors, to give the perception of leadership trying their best so that the artificial destruction of the company could continue to commence. I believe that management knew very well and clear, certainly at the latest 2010, maybe even '08 or '09. I think they knew exactly what they were doing. And whether or not short sellers were already in the mix, I don't know. It could have been less nefarious, It could have been management saying, hey, we see the weakening of the video game business, but we don't know how to fix it. And even if we did know how, it would be a lot of work to fix it. And we would rather just keep the equity money coming, the investor money coming, the stock compensation coming. Like, just pay me what you're going to pay me. I'm not going to buy any new shares, but I'm going to keep telling you what you need to hear to try to keep this merry-go-round going as long as I can. And if I need to distract and distort numbers, I will. I'm going to get into the Fugazi electronics business in another video, but what do y'all think? What did you learn? Do you feel like management was being genuine in this business and growth strategy communication that they offer at the end of 2010, beginning of 2011? And if so, if you think that was genuine, how? Right? I want to hear it in the comments. And if you think that this was them basically waving the white flag, do you think it was nefarious or not? Do you think either way it's nefarious, but do you think short sellers were already involved, that the bankruptcy of GameStop was already being priced in or preyed upon? Do you think the management was benefiting directly from bankrupting the company, or do you think management was just trying to string along Wall Street as long as they could? They didn't necessarily want it to go bankrupt. Like, they wanted to keep it going as long as they could until eventually they couldn't, right? What do you think? Do you think it was premeditated and more nefarious, or do you think it was just people trying to get paid wealthy salaries without wanting to put in the work to actually transform their business because they didn't actually care that much about the business? It's one or the other. There's no there's no possible way that management felt this was in the best interest of GameStop. And if you feel differently, would love to hear why. And again, if if this wasn't um, if this wasn't an intentional, like if this wasn't to help GameStop, but it was just to either string along Wall Street or to expedite GameStop's bankruptcy, it makes the rest of GameStop's decisions make so much more sense, because in the following years, there's just several new flash in the pan growth stories, several times that they change the way that they report their sales, several times that they're spending money on acquisitions of more companies, right? They are burning through cash like crazy. They're changing their narratives like crazy. They're changing their accounting like crazy to hide from you the reality that the business is tanking and they don't want to do anything about it. And I'll show that to you uh, even deeper as far as how those accounting changes happen and where we can see some fugazi growth stories in the midst of it. And then the one growth story that actually hit, and I want to show you how crazily it hit. I've already talked about it some, but I want to show you at even deeper level, and how GameStop, as soon as one of those growth stories actually panned out, they immediately abort it and sell it for pennies on the dollar. It's just crazy. So, in my opinion, by 2009 at least, conservatively, you could say 2010, aggressively, you could say 2008, management knew exactly what they were doing. They were never interested in the long term success of GameStop until, of course, Ryan Cohen came in. And now here we are, trading at less than the amount of cash GameStop has in the bank. Can you imagine that after everything I've talked about, right? All of these years where GameStop's obviously self-imploding, where they obviously are communicating things that don't make sense, strategies that won't work that we've already seen tested for 5+ years, even then, their enterprise value was higher than GameStop's enterprise value today. Can you believe that? It is just shocking that you can buy a share at GameStop today for less, like at a book value, whatever, for less than the cash they have in the bank, right? Their market cap right now at 9 billion is less than the cash they have on hand. Absolutely wildness that the GameStop of 2011 Wall Street said, yeah, it's definitely worth somewhere between 3 and 4 billion. And the GameStop today is apparently worth nothing, despite sales that are growing hundreds of percent year over year in their collectibles division, sales per store blowing up, right? We just talked about how sales per store grew from zero point 0.5 to staggering out at 1.4. Well, they managed to keep up that 1.4-ish through acquisitions for several years, but inevitably that sales per store started coming down, right? 1.4, this is when the full implosion mode was happening. They still couldn't get it below 1 million per store, even when they were trying to destroy the company. But look where it is today, on pace to do $2.2 million in sales per store, almost double where it was just a year ago, and 80% higher than it was back when they were valued as an 8, 9, $10 billion enterprise, which would represent a 2, 3x from current levels. I mean, just wild. Wild. All right, that's all I got for y'all today. Let me know if you learned anything. Thank you, everyone who's joined the sub club. All of the above. I appreciate it. See you in the next one.